Hello, everyone. Today on the final bar, my guest is Jonathan Krinsky, joining us from Minnesota, sharing his thoughts on the market, some seasonal tendencies. We're sort of in that weaker part of the year, but it's lining up with some real internal weakness from stocks for sure. The S&P chopping around for a good amount, but certainly finishing on the downside. Small and mid caps leading the way a little bit further. So it's all about that 3,200 to 3,400 range, and whether buyers or sellers take control to push us out one way or the other. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together through the lenses of technical analysis and behavioral finance. As we've talked so many times on the show, the goal here is to look at the short-term movements, see what's happening today, what's working and what isn't, but most importantly, don't get caught up in the short-term fluctuations. Think about the long-term ramifications, identify some key levels, key patterns you're looking for, and then use the daily routine, use the flickering ticks of the day to see how we're relating to those long-term trend assumptions. I'm excited to welcome Jonathan Krinsky back on the show today, talking a little bit about some of the seasonal trends. We're in that weakest part of the year, so the pullback we've seen is not unrealistic. But it's all about where we go from here and how we depart this range from S&P 3,200 to 3,400. The market can go three directions, up, down, or sideways. We've had a little of all of those in the last 6 weeks. Question is what's going to be next. As I mentioned, Jonathan Krinsky joining us from Minnesota in a few moments. Coming up the rest of this week on Wednesday, on the 30th, we have John Kosar from Asbury Research in Chicago. On Thursday, October 1st, Guy Cerundolo from Cerundolo Investment Research in Boston. Coming up next week, we have joining us the first time, Jay Hatfield from New York. Jay's a portfolio manager at Infrastructure Capital Management. I had some great conversations with Jay about just income-oriented investing, how to think about low rates and potential market downside from an income perspective and what levers you can start to pull. So excited to get Jay's take on the world coming up here next week. Let's get to our market recap. So as always, our goal is just to focus on the short-term changes and then connect it to the long-term trends. Speaking of that, we asked you a poll recently. We usually have a poll going on our TV page, so make sure you check it out. We asked you, what's your average investment horizon? And I gave you four choices: a couple minutes, a couple days, a couple weeks, or a couple months. Almost half of you, 49%, said a couple months, which would, in my opinion, classify you as a long-term investor. That's sort of that long-term time frame, a couple months and beyond. And to be honest, what you should know for that 49% of you, you should be a trend follower. All else being equal, everything in a vacuum. If you look at the data, if you're over 3 months out, you're better off betting on what has worked as opposed to trying to bet on what has not worked, right? Things on that time frame, things don't tend to mean revert. They tend to be tend to follow trends. So your goal should be to identify outperformers, identify underperformers, and lean into what's working, lean away from what isn't. 32% of you said a couple weeks, and at that point, you're sort of in that, couple days to a couple weeks. You're in sort of that shorter term time frame, or what I usually call medium term, actually, which is more of a swing trading environment, looking at things and how they revert. And I think that's, if you're looking at the markets right now, if I'm you, I'm probably looking at this rebound off of the lows, and hopefully have identified some opportunities there. Only 8% of you said a couple minutes, and that is obviously an ultra short time frame if that's where you're looking. Even if that is how you describe yourself, though, I hope the charts that we look at here are still a part of your thinking, because even if you're a short-term investor, the long-term trends, that's where big institutions are navigating. That's the time frame they're on. So knowing what they're knowing is a good thing to do. In terms of our recap, the S&P, as I mentioned, down almost 0.5% to 33.35. Mid caps and small caps down a little bit more, but they were all kind of in that 0.5% range, if not a little more. The VIX up to about 2650. Looking at other markets, bonds are one of the few that were actually in the positive today. Really, most of that was, in the morning session. The afternoon gave most of it away to finish essentially flat. And the dollar's a little weaker today, down 0.5% in the form of the UUP. Gold and silver also some maybe potentially the most positive out of all the movers, with the GLD up almost 1%, silver up 2%. Let's look at that chart to start with, and then we're going to go to the chart of the S&P. So again, a day like that on gold is this little bar among 2 years worth of bars. Let's tighten this up maybe to a year, which will make it a little easier to follow here. You know, the perspective I would encourage you to focus on if you're a long-term investor is essentially everything was in an uptrend. Get the dollar out of the way. Everything else sort of accelerated into the August highs. Here's the GLD. We'll look at the S&P in a minute. We'll look at bonds, but you know, sort of everything's now come off a little bit, right? At some point in the last month or two, metals sort of led the way down and have retraced quite a bit relative to some other asset classes. But overall, everything's sort of been in pullback mode. Again, dollar aside. And the question now is, you know, in my opinion, my experience, that tends to be unsustainable. You don't tend to have stocks, bonds, and gold all moving in tandem. And that's kind of what you've had now, where they've all kind of pulled back and now they've all bounced just a little bit off of the lows. And the question now is, which one is going to give? At least one of those asset classes is going to break down through a key support level. On the GLD, I think it's this 172.50 to 171 level. That's a confluence of support. That's the Fibonacci levels we've looked at. That would clear the way for potential for further downside. If you're looking at bonds, we could look at the AG or the TLT, and, you know, again, accelerating into a peak in August, coming back. And now it's really settled into the 118 level, maybe a little bit below that, as being consistent support. You know, if that maintains, if we hold that, it's outperforming other asset classes just because it's not going down. It's not showing any real signs of trouble. But if it would break down through 118 and really follow through the lows from August, that would be a breakdown on that side. And now we have the S&P, which of course accelerated past August and rallied into a September peak. So bonds and gold sort of topped out back here and rolled over. Now stocks have joined this pullback party, and now they've all sort of bounced even just a little bit off of the swing lows. And again, I think at least one of these has to break, meaning S&P 3200, meaning the AG or the TLT below its recent price support from the last 6 weeks, or gold breaking down to a new swing low as well. And I would certainly be watching those support levels across the board. If you asked me to predict which of these is going to happen, my guess would be gold goes up from here, bonds remain sideways, and stocks go down. But that is a set of assumptions based on a bunch of internals and other things I'm looking at. I'm going to pay attention to the price more than anything and see how the price actually does. Having said that, when you look at the S&P, it's pretty classic how this is traded, right? So you came off of the peak in early September. You've pulled back to that 3,200 to 3,250 range. We've identified this for a while as the peak from June. The retest after the breakout in July sort of has validated this range, and I'm not surprised that that's where the S&P pulls back to. I think, you know, we've talked about this for a little while. I think this is a safe assumption. The question is, what next? Either we're able to reclaim the 50-day moving average, break above 3,400, break above the swing highs here in September, which is the rebound after the first leg lower, which I would say if that happens, I'll be the first to tell you S&P 3,600 should be an expectation going into year end. Or option B, we break below 3,200, at which point I'll be the first to tell you you need to start looking down at these levels like 2,950 and others, which are, you know, taking lower ends of previous pullback periods, previous levels of support. The third potential option is that third direction, which literally no one wants to experience, which is we just remain in this range for a while. And we could. That is certainly one of the directions, up, down, or sideways. But again, a break above 3,400, a break below 3,200, that's sort of the binary outcome I think is pretty safe going, you know, coming out of this September, October period. Looking up, let's get back to our dashboard here. Let's look at what else sort of happened just to wrap up this market recap today. Only one of the 11 S&P sectors finished in the positive. That's communication services here. The XLC essentially flat, followed by utilities and healthcare. Technology was fourth from the top, but worth noting, pretty much nothing was really up in a meaningful way today. Energy and financials leading the way downwards. And again, I don't mean to beat the table too much or pound the table too much about the technical unattractiveness of energy and financials. And I will say, with the caveat that there are stocks within each of those sectors, probably more financials than energy, that, you know, are potentially constructive. We talked about Invesco, IVZ making a new swing high in our show yesterday. There are pockets of opportunity, things like S&P Global or market access maybe come to mind as well within financials. But overall, as a sector allocation strategy or sector rotation strategy, there's very little on those long-term relative charts that would compel me to want to think about those until you get more of a rotation. That's even with some of these bounces in energy. The long-term relative trend has been pretty weak across the board. Just want to finish off by pointing out there were some individual groups that did better. Footwear, that's like Nike's group, is up the most today. Within materials, you had mining and gold mining stocks. The internet group within communication services, that's why comm services was the number 1 sector. And semiconductors, we talk about the relative performance of semiconductors, and it when it continues to appear in that upper half of the upper top 10 list of industry groups, it makes me want to revisit that relative chart and see if it's holding up, because if so, that tells you that things aren't that bad if semiconductors are doing that well. We need to take a quick commercial break. Back with my guest, Jonathan Krinsky. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday after the close for the show. As a reminder, we're going to do another mailbag segment a little later in today's show. We'd love to hear from you and answer one of your questions at our next mailbag segment at the end of this week. You can get questions to us a couple ways. First is via email, thefinalbar@StockCharts.com. Second is on Twitter @FinalBarSCTV. Third is on YouTube or anywhere you see our content. Just put a comment below the video. We'll capture all of those and hopefully answer one of your questions in our next mailbag segment at the end of the week. I want to welcome on my guest, Jonathan Krinsky, normally from New York, but given the circumstances, coming to us live from Minnesota. Jonathan, welcome back to the show.
Thanks, Dave. Always a pleasure.
So Jonathan's at Baycrest Partners, and we were talking just before the show. You sent a couple charts. The first one is sort of this. I'm anxious to hear what you think about growth versus value, because this, we've heard about the return of the value trade many times, I know, over our careers. What are you seeing now, looking at these two styles here?
Yeah, so we obviously had that big 10% drawdown from the highs from the peak in September. I think growth, and when we talk about growth, it's if we're looking at something like the IVW, which is the S&P 500 growth ETF, it's about 65% in what most people would consider technology. Now you have some Amazon's consumer discretionary and Facebook, Google are communications, but those are the FANG stocks that we all talk about. So we're really talking about technology. The growth ETF is very similar to the NASDAQ 100 or the Qs that we're also familiar with. So I think that's really the key here, because it's such a dominant weighting within the overall S&P 500. And so we now have a level that's pretty well defined that we can kind of use as some risk parameters, and that would be the February highs. We pretty much got down to those February highs last week, and we held. So, I think there's times in the market where you kind of have a pretty good sense maybe of where things are going. There's other times where you don't necessarily know, but at least you have some defined levels. And I think that's where we're at right now. Our view basically is that the bulls held where they needed to, particularly in growth. If we were to go down and now break last week's lows, then I think you can make the case for another 10% downside in these growth names, particularly NASDAQ 100. And that probably coincides with a test of the 200-day moving average, that we haven't seen in the NASDAQ 100 since we broke above it back in April. So that's the growth side of the equation. The value side, or the cyclicals or the reopen side that we talk about, really continues to struggle. We actually were encouraged on Friday because you had a lot of the stay-at-home plays up strongly, but you also had airlines and and hotels and cruise lines up. And we haven't seen a day like that where both were up strongly since May. So we're encouraged with that. But again, we come in this week and there's just really no follow through. So, we're a little bit in wait and see mode, but I think, at least you do have those levels to trade against as your support that you talked about as well.
Yeah, I hear what you're saying. And I feel like anytime I've recognized at least some short-term, sparkle from the value trade, that I always hear myself saying, all right, we just need some follow through. And then I feel like we just never quite get that. So you're right.
Yeah.
I mean, growth has certainly remained resilient. Now we're obviously in the, this period of the calendar when most people start, questioning seasonal tendencies. Tell us about what the calendar is looking like between here and year end.
Yeah, so seasonal factors are obviously just one small part of the equation, as you know. And what we have here is a chart of the average path of the S&P 500 over the last 30 years. So if you were to take each year on its own and just kind of merge them all together, this is what the average path would look like. And what you tend to find, again, on average, is that we see some weakness in September, particularly late September, and then the market tends to find its footing in early to mid-October, and then you tend to see that nice strong fourth quarter rally. Now, you could overlay the election year pattern with this, and it's very similar. If anything, there's a bit more weakness extending through October, and that makes sense. If you think about it as election uncertainty tends to persist until November. But I think the takeaway here is not that this is a guarantee that we're going to rally in the fourth quarter, but it's telling you that the seasonal factors are now becoming a tailwind. They're no longer a headwind. And you combine them with the fact that we've had this 10% pullback, that makes the bullish case a bit easier to kind of frame. Now, if we're to start to deviate from this, does that mean we just ignore the price of the market and say, well, seasonals are strong, so we're bullish? Absolutely not. But it is just one factor to consider.
So we only have about 30 seconds left. This is a great set of charts, Jonathan. I'm curious, you sort of alluded to it here, but if you think about different levels we can pull in our analysis, sort of looking at price, looking at market breadth, maybe looking at sentiment, and then maybe seasonal cycles, sort of things like this. Where does a seasonal trend fit into that spectrum for you, and how important is it if you see a pattern like this emerging?
Well, I just think seasonals are just one part of the pie. But when you see stuff that deviates from that seasonal pattern, and I think 2018 maybe is a good example.
Sure.
We started to show weakness, in mid-October and even late October. So maybe that was a telling sign. So let's watch the next couple of weeks. Watch how the market trades in response to news, as more so than the news itself.
That's fantastic. Jonathan Krinsky from Baycrest Partners, thank you so much for coming back on the show. Hope you and the family stay safe in Minnesota. We'll hope to hear from you again soon, all right?
Thanks, Dave. You as well.
This is Jonathan Krinsky joining us from Baycrest Partners, usually based in the New York area, given everything he's coming to us from Minnesota, and great to hear from him. I followed Jonathan's work for many years, and I I love his answer on how to think of seasonal trends, and it mirrors sort of how I bucket it. You'll hear me rarely talk about cycles and patterns like that, because for me, it's sort of what he mentioned it. If you caught it, he said, look, it's if the cycles are telling one thing, but the price is telling you something else, follow the price. And I feel like I've said follow the price many times on the show. And so that's why I think his comments make a ton of sense. Great charts though. All right, our next segment is called the Final Bar Mailbag. This is where we love to take some of the questions we received from all of you in the last couple of days and address them on the air. Let's get to it. The next question earlier, I think this one's on Friday, I want to say, I was using the RRG, and the question was, if you put the IWM, the small cap ETF, on the RRG, what would it look like? So let's take a look here. So this is the RRG I usually refer to, which is taking the 11 S&P sectors. Sorry, real estate. We're just going to drop you off here and put the IWM on here. So this is the weekly view of where the IWM fits in, and let's take a look. So you can see that small caps, this is on the weekly view to start with. Small caps are sort of they're in the leading quadrant, and they're sort of chopping around, and it looks very similar to things like consumer discretionary materials, similar sort of thing where they've been outperforming by the fact they've been moving to the right. They're further on the righter half, so they're outperforming some of these others, but sort of chopping around and heading more in a downward direction, which starts to make you think that there might be slowing down a bit. So let's look at the daily view, which is here. Here we can see the IWM right here, and it's actually lining up really similar to what healthcare is doing. So we talked on the last show, and we might have done this yesterday too. I forget exactly when we went through it, but if you look at the daily RRG, the rotation graph, it's sort of all vertical, right? You have the things that had been leading for a little bit, kind of on this right side materials, maybe the most noteworthy that just all of a sudden is heading more and more due south and now southwest is what I call the direction of deterioration, which tells you it's still outperforming, but the momentum's totally coming out of that relative performance. See the same thing with financials, consumer staples. These were sectors that just started to show some signs that they were outperforming, but all of a sudden you look and now that momentum has sort of come off. Healthcare is another one where there are opportunities within healthcare, but as a sector, performing okay, but on a relative basis kind of coming off. And small caps are very similar to that. The ones that are emerging more in constructive patterns are technology and communication services. And as I mentioned, I think seeing whether this rotation sort of continues and these guys head more northeast, these ones head more southwest, I think would tell you about a little more, further rotation in that direction, what we've seen just recently. So small caps actually on the short term looks very similar to healthcare, which is of interest. We've talked about the lack of participation in small caps, and in terms of one overall part of what I've considered more of a bearish thesis here, at least going for the next couple of weeks for sure, is that weakness, that lack of confirmation from small caps, and not just on the price, but really on the breadth more than anything. Next question is longer, so let me come off a little bit here. I know your priority sequence of price, breadth, and sentiment. I've used it in my trading with great success. Well, I'm glad at least one person I've confirmed has heard how many times I've said that. This past week, I came across on Twitter another CMT named John Kopp, and he published a great article on breadth. So I read your article, and thank you for sending that. I know John. I met him years ago through the CMT Association. He's a thoughtful analyst and certainly worth a follow if you haven't done so already. His blog is something like looking at charts from the beach or something like that, which is well done. But on Twitter, CoppJC, COPPJC. The charts he did are similar to this one. I could try to recreate it just a little bit. This isn't exactly what he was showing, but the idea of it was the same. And he was basically looking at breadth and the percent of stocks above their moving averages, not just on the S&P, but in other places. And I've showed random charts like this. It makes me think I want to spend a little more time creating a good chart that I would show more regularly. But here we're looking at the S&P on the top for the last 2 years. We're looking at the percent of S&P stocks above their 200-day, percent of NASDAQ 100 stocks above their 200-day. And at the bottom, this is the percent of the technology sector, the XLK, above their 200-day moving average. A little different. It's actually the exponential moving average, but similar concept. You're looking at what percent of the sector above longer-term moving averages. It's worth noting just on these three that the S&P is the lowest of the three, right? The NASDAQ 100 is the most, 84% of the NASDAQ 100 above their 200-day moving average. So you see the weakness is really in a lot of the other names. So, as you're looking at the relative performance of technology, as you're looking at growth versus value, as you're looking at the Qs versus the diamonds and all these other ways of comparing technology versus other stuff, this might be another really interesting way to do that, is look at some of the breadth measures on some of these specific things. So great chart inspiration, John Kopp, and thanks for sharing that article with me. The next one, I've been reading John Murphy's book, which is a great call. I'd certainly recommend it as the first book I ever read on technical analysis. I came across another interpretation of the broadening formation, which was recently discussed as a topping formation on the final bar in another StockCharts videos. Here's my interpretation from the Elliott wave perspective, which this is the chart you sent me. Thanks so much for putting a chart together, putting all the labels on here. So, your comment, I talked about this broadening pattern, and I went on Bloomberg television a couple of weeks ago and mentioned this, and they jumped on it and said, so we're thinking S&P 2000. And I sort of tapped the brakes a little bit on the potential of going all the way down there, but the pattern is certainly valid, which is a big run, and then you have a broadening pattern, means instead of lower highs and lower lows, which is a consolidation, this is higher highs and lower lows. So it's a broadening out. It's an expanding of the range. You are taking this more from an Elliott wave perspective, and I assume looking from the '09 low, which is where you'd have to start. This is wave one here, wave two, wave three, and then this is a big, triangle sort of expanding flat or some expanding, I forget what the Elliott wave term is, but an expanding triangle maybe with a reverse triangle with higher highs and lower lows. And then a breakout above here basically means you have a big wave five going much higher. So listen, that absolutely could happen. I would say in general, again, as you probably know, I'm not a big Elliott wave person, but I am noticing in your counts, if you're starting wave one here, which you can't do, you have to start wave one down here, which means it's highly unlikely this is one big wave one, and then wave three is this, because wave three is never the shortest wave, if I remember my Elliott wave correctly. So I would revisit your count a little bit. I think you could get away with saying like this is wave one and wave two, and then this is a big wave three. But I'd have to look more at the substructure of that one and see if that actually worked. That might be a little more accurate. Having said that, you're absolutely right. This could be one big wave four. And again, I think the challenge there though is you would need to break to new highs. And if you break 3,600 on the S&P, you continue to push higher. You see volume go in, and you ride through the end of the election season into the new year. Certainly could be much higher upside from here. That's absolutely a potential target. But on the wave counts, I would look at that again. Just in particular, wave one feels a little abnormal to me. The last one, boy, we only have another minute, so I'll hesitate on this one. Any favorite scans? So listen, we're going to get to scanning. Maybe we'll do another a segment in a future show, because I don't want to just minimize this one. But I would point out, if you're not familiar with the scanning engine, I tend to throw a lot of scans around. This scan that I just showed earlier in the week, this was yesterday or the day before, I did S&P 13-week highs. This is actually a super easy scan, and it literally has two arguments. Besides the fact that it's a stock, it says I want stocks in the S&P and a close is higher than yesterday's daily max, and it's looking at the last 65 days on a closing basis. That language you can use for anything, and I literally built that just from taking the components down here. And if you look at the section on price and volume, you can put in highs, lows, you can put in any of those individual components. If you're not super comfortable with how to do these, look at our chart school articles, because we have some articles on scanning. Also, my boss, Chip Anderson, the founder of StockCharts, has recorded some great deep dives on the scanning engine where he shows how to build them from scratch and sort of the logic of them. On a later show, maybe we'll spend a little more time on some of those scans that I've showed regularly. That is our mailbag segment. Those are fantastic questions, and thank you all so much. We need to wrap the show, go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is looking at the long bond ETF, the AG, AGG. We look at the TLT pretty regularly as well. Just to shake it up here, we're looking at the AG ETFs. This is aggregate bond markets. And what we talked about, with stocks, bonds, and gold, gold and bonds topped out in August, stocks topped out earlier in September. They've now all pulled back. And the question is which will hold and which will break down. And I think looking at the support levels on those three asset classes is going to be key. On the AG, 118 is not far away. What's interesting is it's just been sideways for the last 6 weeks. And I could see a scenario where it remains sideways for a little bit longer as rates remain muted. Chart number two is the bullish percent index. We talk about this occasionally. It's one of the part of our breadth indicator package that we review with some regularity. And I just want to point out, yes, the bullish percent line has gone below 50, which in general either means we're in a pullback or it could be something deeper. And if you look at some of the deeper sell-offs, like here in earlier in 2018, if you look here in February, when you broke below it, we continued a lot further, and that really spoke to the internal weakness of a lot of stocks selling off. We haven't quite had that yet. At this point, it still looks like some of the viable pullbacks within the last 6 months. So seeing whether that remains below 50% for an extended period of time would certainly give more validity to potential downside. And then the last point is just to remind everyone, we're looking at financials, when you're looking at the value trade, looking at energy, I would be keyed in on that relative line. And until the relative line improves, I would hesitate to be allocating somewhere like financials, which have just demonstrated their ability to underperform consistently. That's our show for today. I want to thank Jonathan Krinsky from Baycrest Partners for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.